China started emerging as a global economic powerhouse, producing goods for the world and earning billions of dollars. Those dollars needed a safe place to go, and China chose United States Treasury securities, seen as the gold standard of investments. By 2013, China held a staggering $1.3 trillion in United States debt, making it one of the largest foreign creditors. Fast forward to 2024, and that number has dropped to around $760 to $860 billion. What changed? Why is China stepping back from United States debt? And what happens if China stops buying it altogether? This question sparks curiosity because it touches the delicate balance of global finance, where one nation's choice could ripple across economies, markets, and even everyday prices. Let's dive into the story, tracing how China became a major holder of United States debt, why it is reducing those holdings, and what it means for the world. China transformed into the world's factory, manufacturing everything from toys to electronics. Factories hummed, exports soared, and dollars poured into China from trade with countries like the United States. China held only $70 billion in United States Treasury securities, while Japan, then the largest foreign holder, owned over $307 billion. But China's economy was growing fast, fueled by a massive trade surplus, exporting far more than it imported. Those surplus dollars could not just sit in a bank, they needed to earn returns. United States Treasuries, bills, notes, and bonds, offered safety, liquidity, and stability, backed by the United States dollar, the world's primary reserve currency. China's trade surplus exploded as American and European companies set up factories in China, drawn by low costs. By selling goods abroad, China amassed unprecedented amounts of foreign currency, especially dollars. 2008. China's holdings of United States Treasuries skyrocketed to over $700 billion, surpassing Japan, which held just over $600 billion. This wasn't just about safe investments. China strategically bought United States debt to keep its currency, the yuan, weaker, making Chinese exports cheaper and more competitive. 2013. China's holdings peaked at $1.3 trillion, a massive stake in United States debt, which itself was climbing, reaching $35.4 trillion by the third quarter of 2024. Why did China invest so heavily? United States Treasuries are considered the safest assets globally, with minimal risk of default. The Treasury market is vast, with daily trading volumes often exceeding $500 billion, allowing investors like China to buy or sell large amounts easily. Plus, holding dollar-denominated assets made sense for China, as central banks worldwide keep reserves in dollars to stabilize their economies. But this financial relationship wasn't just about economics. It tied two global powers in a delicate dance of mutual dependence. China's holdings of United States Treasuries began to decline, dropping to $760 billion by October 2024, according to some estimates, or $860 billion by others. Why the shift? First, China poured massive funds into the Belt and Road Initiative, a global infrastructure project connecting Asia, Europe, and Africa through roads, railways, and ports. 2018. China invested over $50 billion in a single year into this initiative, using foreign reserves, including dollars once parked in United States Treasuries, to finance these ambitious projects. Building ports in Pakistan or railways in Kenya required liquid cash, and selling United States debt provided a way of funding it. Second, China joined Brazil, Russia, India, and South Africa in the BRICS alliance, a group aiming to counter Western-dominated financial systems like the International Monetary Fund and World Bank. BRICS nations, including China, sought to diversify reserves, reducing reliance on United States Treasuries. Instead of dollars, they promoted local currencies and alternative financial systems to shield themselves from Western policies. This shift reflected a broader goal: economic sovereignty. Third, China turned to gold. While United States Treasury holdings fell, China's gold reserves grew, measured in tons, as a hedge against financial disruptions and geopolitical tensions. Gold offers stability, free from the risks tied to any single country's economy. By 2024, China's move toward gold signaled a strategic pivot, prioritizing long-term security over short-term returns from United States debt. What happens if China stops buying United States debt? Now, imagine China halts all purchases of United States Treasuries or, worse, sells off its $760 to $860 billion in holdings. What would happen? The United States Treasury market, massive and liquid, relies on steady demand from foreign and domestic buyers. China stepping away would reduce that demand, forcing the United States Treasury to offer higher yields to attract new investors. Higher yields mean higher interest rates across the economy. Over 60% of United States debt is held domestically by banks, pension funds, insurance companies, and mutual funds. But a sudden exit by a major player like China could still shake things up. Higher interest rates would increase the United States government's borrowing costs, already strained by a $35.4 trillion federal debt. Servicing that debt would eat into the budget, potentially widening the deficit. For everyday Americans, this could mean higher rates on mortgages, car loans, and credit cards, squeezing household budgets and curbing spending. A sell-off could also weaken the United States dollar. If China converts its treasury proceeds into other currencies or assets like gold, the dollar's value could drop. A cheaper dollar might boost United States exports, think American cars or soybeans selling better abroad. But imports, from Chinese electronics to European wines, would cost more, driving up prices for consumers. Inflation would creep into grocery stores, gas stations, and clothing shops, hitting wallets hard. Global markets would feel the tremors. United States Treasuries are a cornerstone of financial stability, seen as the world's safest investment. A Chinese sell-off could spark panic, with stock markets tumbling as investors fear rising rates and economic slowdown. Countries relying on dollar reserves, like those in Asia or Latin America, might face capital outflows and currency depreciation, destabilizing their economies. 2024. Daily Treasury trading volumes exceed $500 billion, so the market might absorb some shock, but a rapid, large-scale sell-off would test its resilience. China dumping United States debt might hurt China as much as the United States. Selling $760 to $860 billion in treasuries would flood the market, driving down bond prices and devaluing China's remaining holdings. It's like selling a house in a hurry, you get less than it's worth. Plus, there's no clear alternative. Europe's bond markets are fragmented, and Japan's are too small to absorb China's reserves. A global financial crisis triggered by a sell-off would slash demand for Chinese exports, from smartphones to clothing, stalling China's own growth. This nuclear option is a lose-lose scenario. The United States has defenses, too. The Federal Reserve could step in, buying treasuries through quantitative easing, as it did during the COVID-19 pandemic. Other countries, like Japan, holding over $1.1 trillion in 2024, the United Kingdom, and Middle Eastern nations, continue to buy United States debt, filling gaps left by China. Domestic investors, holding over 60% of the debt, provide a stable base. 2024. China's gradual reduction from $1.3 trillion in 2013 to $760,860 billion hasn't caused a meltdown, thanks to these buffers and low interest rates. Possible scenario: the future. Let's explore 3 paths forward. First, the base case. China continues its gradual reduction of United States Treasury holdings, as seen from 2013 to 2024. The Federal Reserve manages interest rates, and domestic and foreign buyers step in. The United States economy adapts, with minor ripples but no major crashes. This slow shift keeps markets stable, as China balances its Belt and Road investments and gold accumulation with careful dollar management. Second, the worst-case scenario. Geopolitical tensions, say, over trade or Taiwan, escalate. China aggressively sells its $760,860 billion in treasuries. Interest rates spike, the dollar crashes, and global markets plunge into recession. Stock markets drop, consumer prices soar, and countries tied to the dollar scramble. This chaos would hurt China, too, as its export markets shrink, but the damage to global confidence in United States Treasuries could linger. Third, the best-case scenario. The United States and China negotiate new trade and financial agreements, easing tensions. China keeps buying United States debt, though at a slower pace, prioritizing stability. Both nations benefit from steady markets, and the dollar remains the world's reserve currency. This path avoids shocks, letting economies grow without disruption. Why this matters: the United States and China are locked in a financial tango. China's investment in United States Treasuries, once $1.3 trillion, now $760,860 billion, has funded American deficits while giving China a safe place for its dollars. But as China shifts to gold, the Belt and Road Initiative, and BRICS, the balance is changing. 2024. The United States federal debt stands at $35.4 trillion, and the Treasury market's daily volume exceeds $500 billion. A sudden Chinese exit could raise rates, weaken the dollar, and rattle markets, but the United States has tools to soften the blow. This isn't just about numbers. It's about the price of gas, the cost of a home, and the stability of global trade. Could China's choices reshape your grocery bill or the stock market? Will the United States dollar stay king, or will gold and other currencies rise? The answers lie in this complex relationship, where one move could spark a chain reaction. What do you think? Can the United States and China keep this balance, or are we headed for a financial shake-up? Share your thoughts below, and let's keep exploring the forces shaping our world.